quickly take you through some of the slides that weren't on my original and might add a little bit more color to what I was pontificating about earlier. We want to look at this almost as a report card, where we are today versus where we were when we originally purchased this or did a deal on the Pegmont project in Queensland, Australia. So to date, we've raised $9 million. We have currently $2 million in our treasury. We've made $750,000 in property payments. We have $1.5 million remaining, and our exploration expenditures are $6 million to date. Our option commitments for exploration expenditures have all been met. We had 17,000 meters that we needed to drill. We've done 24,000 meters. So those commitments have been met. To date, our cost per meter drilled is $210. I think that's lower quartile in the industry. Our 24,000 meters have effectively doubled the resource, which historically was 5 million tons of lead zinc at Pegmont. On the metallurgy side, we've got a positive metallurgy return last year from our Zone 5 and our near-surface discovery called the Burke Hinge Zone. So we have a marketable lead and zinc concentrate. As far as the mineral resource increase goes, we have a 75% increase in inferred tons and a 44% increase in indicated tons. The other key thing I want to point out is in 2 weeks, we're going to be following up on a copper discovery we made at the end of last season. It's 2 kilometers away from the main ore body. I'm a bit loath to call it a discovery, being in its one hole, but we hit 3% copper over 3 meters and 1.5 grams of gold. And in the significant point geologically, it was hosted within 10 meters of alteration. It's a different style of mineralization at Pegmont, but it could turn into a significant copper discovery if we can duplicate those results, and we plan on a fairly aggressive program surrounding it. In the meantime, from that discovery hole, we did some EM work, some ground-based geophysics, and we uncovered an 800-meter anomaly. So we're looking to test that, as I said, in 2 weeks with great interest. The share structure is pretty well the same as I had before, 114 million out, 162 on a fully diluted basis. As I mentioned before, in the last week, Xinjiang Global Fund has secured a 5% interest in Vendetta. They are controlled by Xinjiang Mining, one of the preeminent mining companies in China. Solitario Zinc Corp is increasing their position from 6 to 9%. They're exercising their warrants. I expect that to be done next week. And Resource Capital Fund out of Denver is maintaining their 23% interest. We have an additional 18% interest in institutional holdings and with management. I talked about that earlier. I'll just, for expediency's sake. Lead zinc. Lead's been one of the better performing metals, if not lead and zinc, during the past, I would say, 24 months. I think there's a bit of a disconnect right now because we are currently trading at $1.40 zinc, yet we haven't seen the zinc companies rise accordingly. I think that's just a lag. The refining costs and the cost at the smelter levels, or pardon me, the refining levels are almost at historic lows. That's the proverbial canary in the coal mine. I think this the metals market for lead and zinc has room to grow. Zinc is still at $1. There's definitely a crunch, a squeeze at the concentrate level in the refineries, and that's why we're seeing $1.40 zinc. Long term, you still have room to go, but I think the key on the zinc market is what is going to be the sustainable price moving forward. Talking to a lot of the metal concentrate people, they think once there's a couple big mines coming into production in the next 24 months, and then once those are on stream and we start seeing maybe a little bit more from China, you could see zinc pull back to $1.10, $1.20. That's actually significant because historically we've done most of the base case scenarios surrounding zinc at 85 cents. So when we put this project together, we use 90-cent zinc and 95-cent lead. It's in one of the best mining jurisdictions, Queensland, Australia, arguably one of the top 2 lead zinc jurisdictions in the world. We also have several companies surrounding us within 24 kilometers that have capacity at their mills that we will probably be talking to moving forward. One of them is Cannington, owned by South 32. Our metallurgical work that we did was in conjunction with their metallurgist. Basically, we're using their recipe. Our metallurgy, if anything, will just get better, and it's already good. I use this slide of Vancouver to it's an analogy to Pegmont. This project was discovered in 1972. Not a lot of work was done on it. To about 1995, it was sort of like the old slide of Vancouver. What it is now in this Mount Isa mining district is akin to that slide on your right of Vancouver. After 1995, 3 major mines went into production in the region, and what they did is with them, they brought the infrastructure, which is the smelters, the haul roads, the concentrates to the coast, the power. So that's really our competitive advantage, and that's the reason that when we did our internal model, we used 90-cent zinc and 95-cent lead, is because we knew we didn't have to get over the hurdle of having a massive capital cost to put this type of project into production if we could find enough ore. There was originally 5 million tons. As I mentioned before, we're up around 11 million. The breakdown is we've increased the inferred resources by 76%, the indicated by 44%. We've got 2.1 in indicated in the open pit shell, 6.3 in the inferred, and our underground resource currently sits at 3 million. We'll have an updated resource out in January, and what we're planning on doing is increasing both the size of our open pit shell and the tons within it, as well as the global resource by drilling in Zone 5, which is our higher zinc zone. There's some of the highlights from the 2017 program. We now have a length on those open pits of 1.8 kilometers by 550 meters. And one of the key tenets of this drill program is our grade has increased by 20% overall. Our widths have increased slightly. The reason for the increase of the grades are we've got the geology, I think, largely dialed in those open pit shells. We have a 77% success rate. We've hit on so far 17 out of 22 drill holes. And when we go further down dip to the underground portion, we have about a 50% success rate. We're still trying to figure out the geometry on Zone 5. That slide pretty well tells the story moving forward. Anytime we've put out good news, and we have been for the last 24 months, the stock has risen accordingly. When we put out the resource, it remained flat. I think that's largely testament to the market we're in. But as zinc price, people realize where it's at. We're already seeing some interest from more of the institutions in the zinc and lead space. So I think the markets are efficient. They'll eventually catch up with what the resource is at Pegmont. And the next 100 days, we're continuing to drill some of our regional expert and conceptual targets. I expect news next week on one of those conceptual targets. We've got resource extensions on the open pit zones, which is the ones close to surface. We're going to drill test that copper anomaly in the next 2 weeks, and then we're doing geotechnical work. This is the development work that we'll need if we decide to enter into M&A or put the project into production ourselves. And then we're doing further metallurgical work and also our flora and fauna, which is needed for development. And it also will be needed for the PEA, which we think we'll be doing in Q2 of 2018. So resource update is in January. I think that'll be critical. We should see about 3 or 4 drill results before then. So there should be lots of news flow. And so far, predicated on the drilling, it's been a successful year. Thank you.